Let's stop pretending this is just another tech cycle. It isn't. This is capital reallocation at machine speed. Look at what's happening right now. AI capex expanding again. Semiconductor shortages tightening. Regional power grids flagging data center strain. These aren't conspiracy headlines. They're earnings calls and energy reports. The International Energy Agency has projected that global data center electricity demand could approach nearly 945 terawatt-hours by 2030. That's nation-level consumption. That is not a startup problem. That is infrastructure stress. And while that's happening, you're being told AI agents are printing money. Run bots 24/7. Build 5 companies in a week. Automate everything. Infinite leverage. On a finite grid. That contradiction is the story. Now, let's get more direct. If AI agents are so profitable, why are so many people selling access to them? Every gold rush creates 2 markets, the miners and the shovel sellers. Right now, the shovel market is booming. Templates, courses, clawbot systems, signal groups. If bots were compounding silently, they wouldn't need affiliate links. Now let's pivot to gold. You've seen the argument. If robots mine 24/7, gold crashes. Sounds rational until you look at cost curves. Gold extraction is constrained by geology, regulation, energy cost, and capital intensity. Labor is one line item, not the dominant constraint. If robots reduce payroll, they increase capex, maintenance, cybersecurity, and infrastructure dependency. Automation doesn't eliminate cost, it reshapes cost. And when automation reshapes cost, barriers to entry usually rise, not fall, which means consolidation accelerates, and concentrated supply doesn't crash prices. It stabilizes control. Now layer macro reality on top. Central banks have been increasing gold reserves in recent years. That's public record. Gold is not priced purely on extraction cost. It's priced on trust cycles, inflation hedging, currency confidence, geopolitical uncertainty. Automation does not eliminate uncertainty. It amplifies economic transitions, which often increases hedging behavior. Now let's move to finance, because this is where acceleration gets dangerous. AI doesn't just trade faster, it compresses hesitation. Before automation, humans staggered exits. Now systems synchronize. The Bank of England has warned that AI-driven systems could amplify instability through synchronized behavior. That's not a YouTube opinion. That's a central bank risk assessment. If multiple models are trained on similar data, they produce similar outputs, and synchronized exits widen liquidity gaps. This is how acceleration becomes fragility. AI agents don't have fear. They have optimization functions. If volatility equals opportunity, they lean into volatility. And when thousands of systems lean simultaneously, price doesn't move smoothly. It jumps. Now ask yourself honestly, are you trading markets or are you trading machine feedback loops? Because those are not the same thing. Now let's go deeper. Everyone thinks AI democratizes power. It does, temporarily. But when everyone gains speed, speed stops being an edge. It becomes the baseline. Baselines create arms races, which compress margins, which is why you're seeing creators selling systems before proving them, startups raising before revenue, traders selling signals before track records. This isn't innovation. It's leverage racing leverage. Now here's the part that will irritate people. If AI can build companies faster than you, then distribution becomes the choke point. If AI can analyze markets faster than you, then capital becomes the choke point. If AI can generate strategy instantly, then execution discipline becomes the choke point. Information is no longer scarce. Infrastructure is. Now let's talk about debt, because this is where AI feels revolutionary. You used to panic when a collection letter arrived. Now you ask, what are my legal options? And AI structures public processes instantly. Validation requests, regulatory frameworks, documentation paths, nothing secret, nothing illegal, just faster access. But here's the shift. When everyone gains strategy, access, institutions adapt, banks use machine learning, platforms optimize engagement, credit systems monitor behavior patterns. Acceleration cuts both ways. You think you're optimizing the system is optimizing you. That's not dystopian. It's symmetrical. Now here's the confrontation. If AI can mine more gold, build more startups, trade faster than humans, then the scarce asset isn't intelligence, it's attention. And attention is already saturated, which is why extreme claims outperform measured analysis, which is why I made $7 million with bots spreads faster than infrastructure breakdowns. But infrastructure determines longevity. Every gold rush ends the same way. Most miners break even. Some lose everything. Infrastructure owners compound. Energy providers, chip manufacturers, cloud operators, settlement rails. If AI is the new gold rush, ask yourself, are you mining noise or studying the rails? Because rails survive volatility. Noise doesn't. Now let's zoom forward 5 years. If automation expands, energy demand rises, volatility increases, central banks adjust. The system doesn't collapse. It restructures. Acceleration doesn't erase capitalism. It intensifies competition. And intensified competition rewards discipline over excitement. That's the quiet shift. It's not robots replacing everything, it's capital moving at machine rhythm. And machine rhythm punishes impulse. If this challenged your assumptions, good. Like and subscribe. We're not chasing hype. We're mapping pressure. This is happening in real time.